What's up, everybody? It's Danny Gould with the Gould team selling Silicon Valley. I'm joined today by my good friend Carl Warden, president of Tax Deferral Strategies. And Carl is a very important figure here in Silicon Valley, teaches at over 70 different real estate offices, talking about a lot of tax deferral strategies that we're going to be covering today, and just a wealth of information. So Carl, thank you so much for taking the time to chat with me today, and want to introduce yourself to the viewers first and foremost and give them a little bit more information about yourself and what it is that you do.
Yeah, my name's Carl Warden. I'm actually many things. I am a real estate agent, although I don't actually really hang my license anywhere. I don't practice real estate. I am a financial advisor, been a financial advisor for over 20 years, been a real estate investor for over 20 years as well. So I understand a lot about real estate. Being a financial advisor, I got a chance to sit in front of a lot of families. I actually ran an office, believe it or not. I don't know if you knew that or not. I ran an office for about 9 years for a firm that would make house calls. We'd sit down with a lot of families and help them out with their financial situations, organize their investments and their insurance and things like that, refinance and basically restructure debt and all that. So I've been in a number of homes and seen a lot. I actually ran the office. I had 40 to 50 financial advisors that worked underneath me at any given time. So pretty familiar with the average household when it comes to their financial situation, and it's very interesting. So when I came across a strategy that allowed for the tax deferment of capital gains on the sale of a primary residence, that resonated really well with me because being a financial advisor, I run across a number of different scenarios or situations where, I can see that people don't necessarily have enough saved for retirement. But a lot of people own homes. And in fact, when we talk about a certain part of the generation, the baby boomer generation, which I, work with a lot of them, 84% of them actually are homeowners. Which is crazy. But 81% of them don't have enough saved for retirement, and that's a fact.
Right.
You can look those numbers up on the internet.
Right.
So when I found out about this strategy, it just really resonated well with me. And having done 13 personal 1031 exchanges as a real estate investor, I called up a good friend of mine, Kevin Herford at Exchange Solutions, and said, hey, you can defer tax in the sale of an investment property. I can defer tax in the sale of any kind of property. That would be a great coalition. And
right.
So it took him about 3 days to make up his mind, but he brought me on board. And so since then, I have really positioned myself, or shall I say tried, humbly speaking, to position myself as the foremost resource for tax deferral strategies on any kind of real estate. So effectively, the way I try to, in fact, I'll even start off my classes by saying there is no longer any reason why you should have to pay taxes on the sale of your real estate ever again unless you want to. So there's options. There's options. You have lots of options. A lot of people don't know that. So anyway, that's kind of who I am and how I position myself in Silicon Valley.
Sure, and just kind of piggybacking off what you just said, I mean, I feel like there's a lot of myths out there when it comes to real estate and taxes, and so I just was curious to hear your take on perhaps the biggest myth that you've heard when it comes to real estate taxes in particular.
Well, it's funny you mentioned that. Yeah, I actually was just called to do a class in Virginia, believe it or not. I'm actually being called to do classes in other parts of the country on what I do.
Yeah.
Because there's really not anybody else doing it, so right. it's working well.
It's true.
But it's interesting. The IRS code is actually 74,668 pages. And the biggest myth is that, when people take a look at that code, and they'll work with their CPA, mm-hmm. right? And when they think about selling an asset or making income or whatever, and they look at that code and they say, this is the code that basically tells me how much in taxes I have to pay. Right? There's also other individuals, the very wealthy, myself included.
Right.
We look at that book and we say, this is the book that shows us how to avoid paying taxes. It's the same book. It's all in there. It's just you kind of do need to know, your way around it. And most people
right.
don't. Most, like I said, most CPAs will, use it to basically show, their clients what they have to pay. But
sure.
they haven't figured out most of them haven't figured out a way how to show them how to keep it. And that's what I do. That's all I do.
Carl, it's the classic glass half full, half empty. And what really struck me about you from the beginning is that you're always looking at the glass half full. You're always looking at how to maximize your impact and the impact that your services can provide in order to really help clients get from where they are to where they want to be. Right? And so piggybacking off of all of that, right now there are just so many folks here, Carl, in Silicon Valley that whose homes have appreciated far up and above and beyond that $250,000, $500,000 exemption.
Right.
And what solutions do you provide to these individuals that would like to, or even more importantly, need to sell at this point?
Well, it's interesting, on a daily basis. Let me tell you the stories I hear literally every single day.
Sure. In
my occupation, because as you mentioned, I actually teach at 76 different real estate offices just in the Bay Area, and I'm now expanding that. But on a daily basis, I'm referred by real estate agents who have clients, and these are the stories. My kids have moved. I want to sell my primary. I want to move closer to my children. How am I able to do that? I bought the property for $100,000 back in 1970 something, right?
Yeah.
Or $200,000 in 1980 something, or $300,000 1990. You know what I'm saying?
Yeah.
And now it's worth 1.5 or 2 or 3.
Right.
Right. How can I sell this and not have to lose, 20% to the feds, 13.3 to the state of California, 3.8 to Obamacare. And oh, by the way, my transaction's actually big enough where it'll actually probably trigger alternative minimum tax, and I'm actually going to lose 50% or more of all my gains. So I don't want to sell, right? So what are my options, right? So that's a story that I hear. It's I want to downsize. I want to I've got this 2,500 square foot house. It's 2 stories. I'm getting older. I don't want to go up downstairs anymore, right? I got the third of an acre manicure dot. I don't want to work in the yard anymore. I don't need this big of a place. It's a 4-bedroom. It's a 3-bedroom. It's just me and my wife now. Maybe I'd like to take some of the equity out of the house and because and they won't openly come out and say, oh, I haven't really funded my retirement. But, fact is I find out most of them haven't. That's just a fact, and it's just kind of the way it is.
Right.
You know what I mean? It's tough living here, right?
Of course.
So, they want to tap, they want to be able to sell. They want to be able to liquidate. They want to be able to downsize. They want to have their cake and eat it too.
Right. Of course.
I'm the you can have your cake and eat it too guy. There you go.
There you go.
End of interview. Okay, anyway, so but no, so basically what I've done is that's how I position myself basically, and I think I already said this already, but we show them how they can do it, and to answer your question, which I don't think I've done yet, that book being over 74,000 pages thick, there's one rule in that entire book that I believe governs the whole thing, in my professional opinion, and that's called the constructive receipt rule. Okay, and basically what it states is this: once you take possession or control of either income from a job, profits from a business, or capital gains from the sale of an asset, it's a taxable event. Okay, the operative words are possession or control. So, for instance, you have a job, you make $100,000, right? Mm-hmm. The job offers a tax deferral mechanism called a 401k. Mm-hmm. Right? You say, boss, I want you to shave off $10,000 of that and send it somewhere else.
Right.
401k. Right? It's a tax deferral strategy.
Sure.
Right? You don't pay taxes on the $10,000. It lowers your income from $100,000 down to $90,000. You only pay taxes on the $90,000. Right?
Of course.
Inside the 401k, mm-hmm. you can invest the money.
Right.
Right? You grow it. You grow the $10,000 to be $10 million. Doesn't matter. You're not going to pay any taxes on the way up. So it grows tax deferred. Right? Couple of rules: don't take any of the money out before 59.5. If you do, it's a 10% penalty in the taxes. After 59.5, you can take the money out. Mm-hmm. Right? In whatever dollar amount or frequency you choose, it's your money. Right? Pay taxes on the money as you receive it.
Sure.
Right? 70.5. Now you're required by the government to go, start taking mandatory distributions. That's a tax deferral strategy. Again, use it. Don't pay the tax. Follow the rules. You can avoid paying the tax along the way until you ultimately take distribution. Mm-hmm. The 1031 exchange works for essentially the same reason. You're the seller, I'm the buyer. In between the transaction, an accommodator jumps into the middle, and now I'm no longer buying the property from you, I'm buying it from the accommodator.
Right.
Effectively, right? So the cash ends up in the hands of the accommodator, not in your bank account. You don't pay taxes. Follow the rules, identify property in 45 days, purchase the property and identify within 180, done deal.
Right.
If it's equal or higher in value and you've moved all the equity into it, reacquired the debt, you're good to go.
Right.
You didn't pay the tax.
Right.
Okay. So we have another strategy. We utilize a trust, and effectively what we do is we position the trust to actually take possession of the property in advance of the sale. Mm-hmm. So this is the 30,000 foot level, but effectively the trust ends up selling the property to the buyer. So the buyer's buying it from the trust. The cash never ends up with the seller. Taxes are avoided. Benefits to it, there's several, but three main ones. Number one, tax deferral. You never touch the money, right? You never took possession of it. You didn't pay the tax. Mm-hmm. Number two, you can invest the money inside this vehicle just like you can inside of an IRA or 401k.
Right.
You know, figuratively speaking.
Sure. Stocks,
bonds, CDs, mutual funds. I mean, if you like that kind of stuff. I don't. Frankly, I'm not really fond of the stock market. So I have more alternative investments, more asset preservation-oriented investments, more guaranteed lifetime income benefits, stuff like that, which is what baby boomers need, right? They want to turn hard-earned equity into income.
Of course.
Then the third benefit is you can then take distributions off this trust in whatever dollar amount or frequency you choose. It's your money, so start taking it out. You pay taxes on the money, just like the 401k, as you receive it. Now that's a very general, discussion, but that is essentially one of the ideas. And in some cases we'll use more than one tax deferral strategy for a client.
Sure.
So in some cases they'll have an investment property as well. So we may start off with something like start off with a 1031 exchange, and then it's kind of difficult to explain, but we'll take advantage of 1031 exchange rules, and then we can convert the money to this trust at a later date. So it's kind of hard to explain again. But there's so many nuances. There's so many things I do. I don't have enough time.
Yeah,
I could be teaching for 2 or 3 hours.
Yeah.
But even a primary residence, believe it or not, if you actually turned it into a rental, right, in the span of about a year and a half to 2 years, you could actually then turn around and rent that property. Put that property up for sale, and sell it, and 1031 exchange it into another property.
Interesting.
Yeah.
Very
so there's some advantages there.
Right.
So. We'll like I say, we combo up a couple of different tax deferral options to ultimately. I've used as many as 3 different tax deferral strategies to accomplish an objective for a client.
Got it. Well, you're just a tax deferral ninja, Carl. I just like crazy.
I have a lot of fun with it. I'm the life of the party. Yeah.
Every time you walk into the room, undoubtedly.
Yeah, big discussion. Anybody want to talk about tax deferral? Okay.
Sign me up, right? Actually, one quick question, kind of piggybacking off of what we were just talking about there, with the trust. Some folks want to sell, but then purchase something, downsize, if you will. Right. Can they still qualify for the 250, 500 exemption while putting it into the trust and take some of that money to use as a down payment?
There's absolutely a way to do it. Yeah, there's absolutely a way to do it. When you buy a property, you're gonna establish a cost basis. How do you do that? Well, if you paid $500,000 for a property, that's your cost basis. That's the basis from which you start.
Right.
How you add to that is you do capital improvements. Significant, not paint. I'm talking like a kitchen renovation or a room addition or a garage addition or a roof. Something like that. That would actually add to basis. So you might put $250,000 more into the property, right? So now you've got a cost basis of $750,000. If you sold it for $2 million, right? Well, let me backtrack for a second. On top of the $750 cost basis, you can then add, if you're single, another $250,000.
Of course, right.
If you're married, another $500,000. Again, provided you lived in the house 2 out of the last 5 years.
Right. So we're talking $1 million to $750,000 in gain. So after exemptions.
Yeah,
cost
exactly.
basis.
So then you take your $750 to $1.25 million. So if you sold the house at that point for $1.25 million, you pay no tax. However, in a lot of cases in the Bay Area, properties worth $2 million. Right. So we got 1.25 tax free effectively, right? But you've got $750,000 of taxable capital gains. which the government could take as much as $375,000 of it. And that might be a non-starter for a lot of people. I've seen extreme examples where somebody might have paid, $100,000 for a property.
Right.
And I see this all the time. And, they get the $500,000 exemption. They made no improvements. They got a $600,000 tax-free dollar amount.
Right.
And the property's worth 1.7. This is the case just recently.
Right.
So they got, after sales charges, commissions, et cetera, they got a net of $1 million of gains, which Uncle Sam is going to take probably half of it.
Right.
And for somebody that, doesn't maybe have a retirement plan, and they're looking at $1 million of actual, potentially even just equity, but it's all capital gains, and Uncle Sam's going to take half of it, that's a non-starter for them. They're like, I'm not selling this thing.
Right.
So there's ways to do it, though. And that's the message that I'm trying to get out. There's ways to do it. You can do it, and you can keep the money working for you.
Unbelievable.
So yeah.
Unbelievable. Hey, just a couple more quick questions for you, because I work with a lot of absentee owners, investors, non-owner occupied people that are renting their properties out, and every conversation starts the same way. Are you thinking about exchanging into another property? And of course, everyone knows the 1031 exchange. It's the it's the one that everyone knows, right? That being said, what other strategies are there to keep that money tax-free that isn't, necessarily a 1031 exchange?
Yeah, because, again, a lot of people know of the 1031 exchange, but, and I wouldn't say maybe a lot of people know about it. They've maybe heard of it, but they don't really know how it works.
Right.
But the biggest issue is that they know that what it essentially means is that they're going to have to maybe take their second home and actually rent it to somebody.
Right.
Before they can sell, because the second home has no real tax benefits. Really. Mm-hmm. If you sell it, there's no 250, 500, right? In some cases, a lot of cases, you can't even write off the interest on it. You know what I mean? So, then when you go to sell it, just pure capital gains, right? On top of whatever the purchase price was.
Sure.
So, again, difficulty in selling a second home can be substantial for a lot of people. So, and a lot of times, mama, right? This was a house that they vacationed in, right? Mama doesn't want to rent it to somebody and let them destroy it for, 6 months or a year until it can become effectively a rental in the eyes of the IRS, right? Mm-hmm. So, so what can you do? Well, and here's the other piece of it too. The other side of it is, okay, well, now I've turned it into a rental, but then what does that mean? I got to sell. I have to buy another rental, right? I don't know if I want to manage property. I'm 65 years old. I've been dealing with real estate. I just want to retire. I want to go sit on an island somewhere and collect checks.
Nothing wrong with that.
Yeah, right. I'd rather let it sit there vacant instead of have to deal with tenant issues.
Right.
Right. But there might be $1.5 million of equity sitting there. And yeah. So in that case, we could utilize that trust idea, and again place the property into this trust and have the trust sell the property. And the trust collects the $1.5 million. And inside the trust, we can invest some money, right? Mm-hmm. And then have that $1.5 million now become a source of income. No tenants, no toilets, trash taxes, termites, turnover, nothing.
Right.
And just an income source.
Right.
And you pay taxes on the income, of course. Can't avoid that, right?
Of course, yeah.
We want everything for free, but you can't have everything for free. But the bottom line is you can make an income off of all of it, instead of whatever would be left over after Uncle Sam butchered it, right? And the other reason I'll tell you that I hear why, and I hear this again every day, the reason why people don't want to sell is because they figure they'll just die owning the property, and then their kids will get a step up in basis, which is true. But the challenge is, again, if you've got that much money sitting there, right, that much value,
right.
Another real estate market turned down. This is the way I see it. Again, for retirees, that's an asset, right? And it's a non-performing asset, just sitting there, right?
Right.
But what if a health condition comes up, and combo that with a downward, a down market, and now they're being forced to sell in a down market? Wouldn't it have been better to sell to capture the $1.5 million in a vehicle that's very safe, very secure, right?
Right.
And not subject to a real estate crash? Not even a stock market crash.
Right.
You see what I'm saying?
Right.
That's
right.
safety. That's security. And the kids, by the way, can also inherit it. So, there's ways to do it.
Right. And not to venture too far off the beaten path, but I know too. You've talked about other strategies that we haven't even talked about here, like the Delaware statutory trust. I mean, all these different things.
Yeah.
I think the punchline is you have options.
Big time. You can turn your non-performing assets into income,
Right.
And you don't necessarily have to pay Uncle Sam in the process of doing it, right? At least initially on the sale, right? And to be clear too, because I'll tell you the most common objection I hear. The most common objection is this: yeah, but you're gonna have to pay taxes anyway, right? And people that say that they don't really, because it's not intuitive. Taxes are not intuitive, and that's something that people talk about every day. You know, you don't have a Carl Warden at your party talking about tax deferral, right? Nobody even wants to listen to Carl Warden, right? They want to talk about the ball game or politics or something like that. But let's get to the root of that misunderstanding, okay? Because let's talk about, if we're just talking about $1 million of capital gains, Uncle Sam's probably going to take half, okay? Now, the argument that, well, I'm going to have to pay it anyway, right? So I might as well just die owning it and get a step up in basis, right? You're missing the point. Yes, if you sold it, you'd have to pay it, which means you have $500,000 left over, right? Now, you're probably not going to take that to Vegas and put it on black and hope to double it, right? That's not going to happen. This is your net worth. This is something you've worked hard for.
Right.
So you're probably going to invest it.
Right.
Right? Assuming you get a very conservative rate of return, let's just say 5%, just to throw a number out there.
Sure.
$25,000 a year is what that $500,000 could generate without touching the principal. Okay?
Right.
Now, if you're able to sell the asset and not pay the $500,000 tax bill, and you're able to keep the full $1 million working for you, and you invest the $1 million in the same exact investment, earning the same 5%, that's a $50,000 a year income. So because you did not pay Uncle Sam, you get to use the money for you and your family.
Right.
And you get an extra $25,000 a year of income. Multiply that times 10 years, that's an extra $250,000 of income you didn't have to pay. You see what I'm saying? That you earned because you didn't have to pay Uncle Sam. And it's not to say that the taxes are not due. They are due. They're captured within this trust.
Right.
You see what I'm saying?
Of course.
So this vehicle, but you get to use the money. Same thing with the 1031 exchange.
Right.
Yeah, but $1 million property, you do the 1031 exchange, you're keeping the money working for you. This is just a different vehicle to do the same thing. It just has a different objective, a different goal, and a different outcome.
Crazy. Carl, you're just a wealth of information. I mean, what final parting thoughts do you have for us at this time? I mean, you've already given me a lot. So, I mean, you've just been great to all my clients and myself.
Thanks.
So we gotta thank you from the bottom of my heart, Carl. And if anybody wants to reach out to you and set up a time to meet or talk about their options, what's the best way for them to get a hold of you?
Yeah, I've got a toll-free number, 877-TAX-STRA, which is short for 877 Tax Strategies.
Okay.
Yeah.
877
Tax Strategies.
Got it.
Yeah, STRA is the 4-digit.
STRA.
Confusing, I know.
I know.
I actually don't know the numbers off the top of my head, but I think the average person could probably figure it out.
Got it. Well, Carl, thank you so much for your
welcome.
time. You are the man. Of course, this is Danny Gould with the Gould team selling Silicon Valley, and we're out.